Hi, good afternoon, everyone. Welcome to our Carrick webinar on preserving generational movement and estate planning. Thanks for joining us today. And I know it's a webinar and sometimes it feels a bit one-sided, but please ask questions while we're going through the presentation. I'll try to ask the relevant questions at the time, and we'll also have time at the end to ask any relevant questions that have been posted. So the reason why we wanted to present this webinar, we actually had a very successful live webinar a couple of weeks ago in our office in Cape Town, and very well attended, and it was really well, but we had a lot of requests for recorded versions. So here we are. So often when I meet clients and we start discussing their estate planning, often the conversation ends quite quickly. People say they've got a will in place and that they sorted. But when we start actually drilling deeper down into their estate planning structures and what provisions they made, they actually start realizing that it's actually only really scratching the surface. And out of a 10 point of 10, having a will in place generally only gives you a 1 or a 2 mark out of 10. So having a will in place is not really proper estate planning. It's just really the very beginning. And as I say, when I meet lots of clients, it's really, through my experiences, probably one of the most overlooked areas in financial planning in South Africa, because people just don't really think what actually the outcome of certain events, certain decisions they'll make it through their career. And that's why I brought this presentation to you. So we've got two very experienced gentlemen with us. One is Louis Venter, lawyer by profession. He's got a very distinguished career, headed up the fiduciary at Citadel and then went to RMB and now heads up Carrick Consult, which is our fiduciary arm of Carrick Wealth. And Rex Cowley is a founder and director of Overseas Trust and Pension, has been in the trust and pension space, specializing in the offshore pension space for over 25 years. So I think you'll learn quite a lot from them today, but we'll dive straight into the presentation now, and you have lots from them coming up. So just to tell you a little bit about Carrick Wealth, so we're so really our focus is about wealth planning and investment planning, and specifically in the offshore space. That's really where our key component lies. Sorry, I'm just second. Okay, so yeah, so we're just going to go through just a bit of an introduction about Carrick, about estate planning, and is a will enough, the generation transfer, and we will refer, there's a common analogy that we use is like the relay race, so passing the baton on from one generation to the other. We'll talk about the ownership structures and the rules of various ownership structures, which are very important with moving assets, about what we'll term as a living liquidation and distribution account, so that we know all the information up front and we don't wait till the inevitable death to start uncovering certain aspects of the estate planning. And then through that, we'll get to various planning opportunities. So just to tell you a little bit about Carrick and what we do. So as I said, we're a global wealth management company focusing on structuring investments. So the key focus areas that we look at around estate planning is, well, I'll go into in a second, but just to give you a little bit more about Carrick's history. So we've got 7 offices in 5 countries. Our head office is in Cape Town here. We've also got an office in the UK in London. We've got an office in Mauritius, Malawi, and Zimbabwe. And we're busy building offices through Africa. So we licensed and regulated in all these jurisdictions. And at the moment, we administer around $600 million for various clients. If you convert that to Rand, you're looking at around over 10 billion Rand that we're managing for our clients. And you'll notice we talk mainly in dollars, because we look at us as our clients as global citizens, and their wealth is should be really priced in hard currency rather than only in rands. Through Carrick's history, we've won several awards. We won a very notable Intellidex, where is really the preeminent award in South Africa, beating out the major other financial institutions in the category of wealthy executives. Sorry, I'm having a bit of challenges with these slides. So really, at Carrick, we've got a holistic approach to wealth planning. So we're looking at clients' growth. So you go through various phases in your life, through building your wealth, managing your wealth, whether it's through equities, whether it's through property. There's various aspects of managing your wealth, and we can help you with many of those as well. Then it's about protecting your assets, so making sure you've got the correct insurances in place. Dealing with businessmen and entrepreneurs, it's very important to have business assurance, key man policies, buy and sell agreements in place, which was very, very important for, especially if you've got partnerships. And then what we're focusing on today is the preservation of wealth. So wills is one of it, but really understanding what goes behind that will and how actually things will unwind. And that's what we're going to go through today. So if we say passing of wealth is like passing a baton, so there's a lot of things that happen when there's generational movement. One is there's the money that gets transferred, and unfortunately South Africa is a very tax onerous environment to live in. So a family can lose 30% or more of their wealth on that transfer of wealth. So there's a financial implication, but there's actually much more behind it than just the money. There's also the family relationships that get affected by this transfer of wealth. How does the family react? How do you access the money? People have got different objectives at different stages in their life. So that's also a very important aspect to cover. And as I said, yeah, there's a tax implications. There's the assets that may even be hidden or not disclosed to various family members that can be lost. And there are there's hundreds of billions of dollars sitting out there with just unclaimed assets. So really again, it's rather planning ahead than waiting for the inevitable. And that's really what we're talking about. I'm going to hand over to Louis now, who's going to take you through the next section of our presentation.
Thank you very much, Sion. Good day, everybody. It's very nice to spend some time with you guys in what we think is a quality conversation about the transfer of wealth and making sure, or at least understanding, what is it that makes for successful succession and what is it that hinders it. So much of what myself and Rex is going to talk about today concerns that topic. But before we start, and I did it when we did the live presentation as well, and perhaps a good way for you guys just to make the things that we're going to discuss a little bit more personal. And obviously we don't know everybody around the room, and this might be in the form of a broadcast, and it might reach you at a later stage. But what I wanted you to do is as myself and Rex go through the topic, imagine that you've got a box of puzzles and you throw the box of puzzles out, and every time we say something that might be applicable to you, what I want you to do is just to put one piece of that puzzle back in the box. So what we usually find is that when we sit in front of you in the consultation space, you might have a 5-piece puzzle, you might have a 20-piece puzzle, you might have a 100-piece puzzle. The important thing is for both of us to understand that puzzle, because we need to put that back together. And what happens is, if we don't do a few things in the planning, and we're going to go through that, and we have to sort these things out after your death, what happens, it's like trying to build a puzzle, but you don't know where the puzzle pieces are, so it's scattered all over the house. You might have a toddler that's been throwing it around. Plus, we have to build that puzzle with the puzzle pieces the wrong way around. It makes it very, very difficult. The puzzle itself might be very simple. It might be simple in your head, but it's really important for other people around you to understand that puzzle as well, because most often that puzzle needs to be built after your death. But I think it is important, and I hope I can manage these slides. Perhaps, Sean, if you can go to the next slide. Yeah, I'm going to ask you to deal with the slides because it might be a bit difficult. I think there's a little bit of a latency. Perhaps just to position, and you'll speak to lots of advisors, and lots of advisors will speak to you. I think it's important to understand how the industry is made up, and who's who in the zoo type of thing from a financial advice point of view. And the reason for that is twofold. The one is to position the advice that and the discussion points that Rex and I are going to address today, but then also to understand that it is critical for you and your advisors to have quality conversations. And for that, the advisor needs to understand your hassle map. So perhaps just to start with this graph. So this graph is very simple. On the one line and the one axis, it's got money that you need, and on the other is your age. Now, what typically happens with human beings is the following. So we start gathering ability from conception, and there's actually from conception till about the age of 6, there's a huge amount that happens in the human brain, but not much in the bank account. So what happens is slowly but surely you start converting that ability, and I just want to stand still there for 1 second and just make the following statement. Ability always precedes wealth. So it is impossible for a human to build wealth. It is impossible for a nation to build wealth, etc., if it's not preceded by ability. And that, unfortunately, we cannot cheat. There's just a bit of a lag. So there's a lag between the ability that you built and the eventual wealth. But typically what happens in most humans is that as you gather your ability, you go through school, you go through varsity, you start turning the ability into income. And then what happens is with that income, you choose a lifestyle. And the difference between what you earn, your income, and your lifestyle, which is what determines what you need, is then accumulated. And what typically happens is the following. And I hope I can use this little pointer. There you go. All right. So if you round about this age, you round about here at age 30, for most people, what they've got is you've got a little bit that's saved. It doesn't mean that your income is low. It is just that which is left after you've spent on your lifestyle. But in case of death or in case of disability, this is what you require. And this line here, this money that I need, is relevant and is true for everybody. We don't know exactly where that line lies, but I know at a certain point in time in your life, there's an amount that you need to fund your spend going forward. So it is actually the present value of the aggregate of spend going forward. All right. Now, obviously, if you're here at the age 30, this line is pretty much irrelevant because you're not there. But if you die, then typically you should get there. And what the industry have done is they've developed products around this need. And most probably it is life cover. So that's typically why the industry would sell life cover to a 30-year-old that has got a high income but doesn't have a lot saved, because this is the hassle map. This is the gap they need to cover. And it is true. So it's not a sale at this point in time, because really it is just complying with what you need at that point in time. But then what the industry doesn't tell you, or nobody's told me that before, is that as you survive a day, you need less, because the aggregate amount you need to cover your future spend is less. On the other side, the more that you save, obviously, the smaller the gap is between what you have and what you need. All right, so slowly but surely you move towards a point where these two lines intersect. And where these two lines intersect is the point where you're financially independent. This is where the financial advisors will tell you it's a great point to reach, because now you work because you want to and not because you have to. All right, and as a very wise client told me a long time ago, he said, you know, the trick in life is to get rich only once. It's really tedious to have to do it twice. So there's a whole industry that developed around preserving the wealth that you've accumulated, and to make sure that you can spend this through your lifetime. All right. Now, these two professions usually don't get along very well. Why? Because the one requires you to buy life cover and the other one wants you to invest. And there's only limited means. And there's a trade-off. The more I spend in life cover, the less I have to put away. All right, but they're all right. The question is, at that point in time, what is the conversation you're having? So when you're 55, surely you're not going to have a conversation with somebody that wants to sell you life cover, because it is not applicable to you. It's not that there's something wrong with the product. It is that there's something wrong with the advice. And at age 50, you need different advice and a different conversation that you need at age 30. And herein lies the point. You are busy on a horizontal momentum a process. So as you grow, as you accumulate, as you age, as your needs change, so does the conversations that you need to have from an advisory point of view. And that then comes to the end of this process here. And this is really where Rex and myself focus our profession. And that is what should be top of mind when you're in this space. So let's say you age 70 or 75, etc. But that what you need is vastly different from what you have. You now have a lot more than what you need. So this automatically says, well, there's going to be wealth that's going to be transferred to the next generation. And just to put that into perspective, we know that there's about 2% of us that will ever reach the point of financial independence. So that is this point where what you need equals what you have. So there's a very small portion of the population that actually have got money to leave to the next generation. But because of the skewness of the way in which wealth is distributed, the amount that of that 2% is actually quite a large amount. So most of what Rex and I am going to discuss with you today really concerns 2% of our population, if that. All right, but the amounts involved is actually quite large. So the question then is, all right, if that is my hassle map, from a quality conversation point of view, the conversation you're having with your advisor, I would guess that this would be top of mind to you. So if you're in that space, most probably that is top of mind to you. What will happen to my children? What will happen in the future when I'm not here? What will happen to my assets? And this is the hassle map that we try to solve. If that gives you some idea, and this is what Rex and I will be discussing today. Now, up to now, we've discussed the horizontal momentum. So this is what happens typically during a person's life as they accumulate wealth. Obviously, there's differences. So if I'm, for instance, the heir to a big estate, obviously what I have line is quite different from somebody that starts out new. The question then is, how can we ensure that the wealth that's transferred to the next generation is done as effectively as possible? And with that, I just want to leave one point with you here. This, although it looks like a two-dimensional graph, this really is a three-dimensional one, because the context in which wealth exists is the context of a family. And with that, we need to understand that this wealth that is being generated will transfer to the next generation. Not only that, you might have at a single point in time, you might have a generation that sits here. So let's call it grandparents. And you have at the same time a generation that sits here, let's call it parents. And you might have a generation that sits here, let's call it grandchildren, and even generations that sits here, let's call it the great-grandchildren. All right, and that happens at the same time. The people live in the same at the same time. Now, the best way for us to explain what makes for successful succession in a scenario like this is for us to imagine the relay race that Sion alluded to earlier. And that's the best way to explain as to what is the rules of successful succession. So how can I pass along wealth with the most success? And what is success there? Success means that you've got one generation following the other and all contribute positively to the accumulation of wealth. And what do we find? We find, and it's no criticism on anybody, but what we typically find is that you've got one generation that builds the wealth, then you've got the next one that consumes the wealth, and then the third one really starts afresh. That is the norm. That is usually what happens. And one might say, well, it's not a bad thing, because it means that there's a circulation of wealth again to other people, etc. Correct. But at the same time, what you've got is you've got this 2%, which typically is one would term them capitalists, and it is a group of people to whom capital is entrusted. And the best people to teach other people about capital would be this 2%. And somehow that process is not happening. But let's go back to this relay race and see what happens. And within this relay race, and you would have seen, if you've seen relays in real time or on TV, etc., it is a very interesting thing, because the whole success of this relay is determined by 2 or 3 seconds where this baton is transferred. It's not about the strength of the runners. And that perhaps is reality check number 1, is that it doesn't matter how strong you are, it is how well you transfer the wealth that makes the difference. But the big thing here, it is not just the wealth that is transferred, it is ability that is transferred, it is understanding that is transferred. And herein lies the difference. And this is the most vital part in this transfer process, is that is it just the wealth that is transferred, or is it ability and understanding that is transferred? What we know is that you are better off receiving ability than it is receiving wealth. And I'm going to give you a few examples. If you let's take for instance Germany after the Second World War. It would have been blown to pieces. All right. The only thing that would have been left is latent ability. And that latent ability, and the same happened with Japan, that latent ability gives you the opportunity within a generation or two to get back on track economically. But that was all that was left, was ability. It's like transferring. It's like the lotto effect. If you receive an inheritance and you don't understand where it comes from, etc., science tells us that the lotto winner, for instance, is in a worse financial position within 5 years of winning the lotto than before. They would have been better off not winning the lotto. And what is lacking there is ability. So just coming back to this relay race, what then typically happens is that first rule of this relay race, if you want to run it successfully, is for you to understand that you are running a relay. It sounds logical, but in life's relay, it simply means that you need to make peace with the fact that at some point in time, the wealth will transfer to the next generation. And at most, you can be a custodian of the wealth, and it accumulates in your hands. And typically, wealth is attracted to good owners. So that typically is the first rule of the transfer. The second, just going through that very quickly, is that the second generation, typically what happens in a good relay race is the one runner looks over their shoulder to the next generation. So there's communication, and this is key. The better the communication and the better the conversation that happens between generations, the higher the likelihood of successful succession. The third rule in this is that there's an open hand. So you've got the second generation willing to accept not just the assets. Obviously, everybody will be happy to accept the assets, but to accept the responsibility of carrying the capital. And it's different. All right, there's a responsibility that goes with that. And that means understanding where this comes from, what the sacrifices were, etc. All of that is true. But there needs to be an acceptance. There also, if you take a business, for instance, if you want to transfer a business successfully from one generation to the next, the second generation need to accept they want to carry on the business. It's no use trying to transfer assets to people that don't want to take it. Same with farming. Don't give a farm to somebody who doesn't want to farm. It just doesn't work. The next rule is when the one generation starts nearing the other, all right, it is important that the one runner starts moving as the other one approaches, so that when the transfer happens, it is a smooth process. One relay runner can stand still and then expect the other one to pass the baton on without that baton being dropped. It just doesn't work, which means that there needs to be a period where the next generation is prepared. We typically find that in trust structures where beneficiaries that's 35, 36 to 40 becomes trustees on a family trust, so that they can start understanding where the wealth comes from, what is the idea with it, and start taking that forward. It typically is what we would find. And then lastly, when this second runner receives the baton, it's important that they run looking forward to the next generation. You can't, in that process, be bogged down by trying to solve the past. things that happened in the past happened in the past, and for you to try to mend things, etc., as you run, what typically happens is runner 2 and runner 3 miss each other. So in that process, there's so much that can go wrong, and it's so easy for me to sit here and say, well, this is typically how a successful wealth succession relay is run, but I know it's extremely difficult. The only thing that I can say is it is directly related to the quality of conversations. The better the conversation is that happens between generations, the better this process is. That is the golden rule. Up to now, this is what typically what sits within your responsibility. You live within this context, you understand your family, you understand your wealth, etc. And this is your responsibility for the successful succession. Where the professional comes in is at the technicalities that is required for the succession of the wealth. And that pattern that you hold, typically you might see that as one block of assets. So you might say, well, everything I own is what I have. And what we typically do is we break that down into 4 silos. All your wealth that you own is owned within 4 silos. There's the trust silo, there's the estate silo, the stuff that you own yourself, there's a company silo, and then there's a pension and life silo. Rex is going to spend a lot of time on that 4th silo, the pension and life silo, because there's unique opportunities, and it's a silo that is often overlooked when we do the estate planning or we consider how to own wealth. I'm quickly going to take you through the first 3 silos and just give you a few pointers as to what needs to be solved. Now, if you compare the general notion out there that estate planning equals the drafting of a will, you will immediately realize how incorrect that is. And it might be true for the 98%, I accept that, but for the 2%, typically what you find is the following. Mostly the trusts are used, so when you've got a trust, you basically created a vehicle where you've entrusted trustees to look after assets to the benefit of beneficiaries, which typically would be yourself or your descendants, etc. But the next generation money typically sits in a trust, and the reason for that is very simple. A trust is the only vehicle of the 4 where you can own assets without owning the vehicle itself or without having a contractual right to the assets. So that makes a trust unique. And you can't, for instance, say, well, should I put assets in a trust or a company? A company, you own the shares. Somebody must own the shares. And through a company structure, somewhere you have to have a natural person or a living person that owns it. So that the trust silo is a unique one. Because you don't own the vehicle, that is the reason why you would not pay estate duty on that. It should not form part of your divorce matters. It should not form part of an estate that is available to creditors if you manage it correctly. But it's got its own rules. So you can't, for instance, deal with assets that's in the trust in your will. The assets that's dealt with in your will sits in silo 2. And silo 2 is the one that would be subject to your marital regime. It would be subject to estate duty. All those taxes that Sean alluded to catches assets that sits in silo 2. And typically as estate planners, that is why what we try to do is we try to get you poorer and the trust richer. Your total capital stays the same, but the vehicle in which it lives is different, and the consequences therefore is quite different. Understanding the silo 2, you need to understand your marital regimes. You need to understand, what does it mean to be married in community of property? What does it mean to be married out of community of property with accrual? Because I can only leave things to people that I own. And silo 2 basically determines, well, the marital regimes basically determines what you own. We do a lot of calculations, and this is where we, for instance, bring in the Living L&D program. The Living L&D program here is very simple in that we try to build this puzzle beforehand. So if you hold assets and we know these assets need to go to the next generation, these are the assets that needs to go through an actual administration of estate process. This is what typically needs to go through probate, etc. And what the living L&D does is it says, well, we know that there's a process that needs to happen after death. There's absolutely no reason why we can't draft the liquidation and distribution account now already. Keep the liquidation and distribution account updated so that when you pass away, everybody knows exactly what has happened. It should happen. It's building that puzzle beforehand and adapting and changing that puzzle as we go on. The third puzzle, the third a silo is a company assets. Again, a company asset is not owned. If you own assets in the company, it's not owned by yourself, you own the shares. To give you an example, if you, for instance, own a house in a company, you can't deal with that house in your will because you can only deal with your will what sits in silo 2. The same with your pension and life. It's in a different silo. It is typically dictated by the policy documents that there's beneficiary nominations that you need to take care of, etc. But as a profession, what we then do is we take your wishes and we take them across all the 4 silos. And we need to manage in each of these silos the process of the wealth transferring from the one generation to the next. All right. Sean, I think this is where it would be handy for Rex perhaps to just discuss the pension and life, but perhaps just before we get to that, and this is about the complexity of the puzzle pieces. What we typically find is, number one, you might have assets in all 4 of these silos. All right, so those are 4 pieces in the puzzle. Then you might have assets sitting both offshore and onshore. That adds complexity to this puzzle because wherever the assets are, we need to go and solve for it. If you've got assets sitting in the UK, in the US, in the Channel Islands, in Switzerland, etc., we need to understand in that country, what is the process of transferring the wealth to the next generation? What must happen there? Then to add to that, you might have heirs that lives across the globe. If you, for instance, live in Australia, there's a difference in receiving wealth from a South African trust, for instance, than to receive it from a South African estate. If you, as an Australian citizen or Australian tax resident, receive distribution from a South African trust, your tax on that is actually quite high. Whereas if you receive the same amount from a deceased estate, for instance, there would be no tax on it. The same with America, the same with UK. Everywhere an heir lives, there's a tax consequence in getting the assets to them. And we need to understand exactly what those tax consequences is to optimize the transfer of the wealth. All right. So you can see within this, depending on where your wealth is, where your heirs are, etc., your box of puzzles might be very simple. Everybody lives in South Africa, and there's a few assets in South Africa to very complex. All right, so what you see on the screen is typically the example of a living L&D, and the product is designed around not doing 2 things. It is designed around not guessing the maths, so you don't guess maths, you do it, and not guessing the law. And it goes down into detail because the detail matters. We can't administer a deceased estate without going into the detail. It's impossible. You need to know exactly where the assets are. You need to test whether, if you think you own the property, whether you actually do. And it's simple to do. It's a deed search, but we'd rather do that deed search before death than after death. Because before death, I can make plans. I can amend your will. I can correct the numbers. I can say, well, it's better to rather have the assets in trust than it is to have it in your own estate, etc. But we can only make those plans whilst you're alive. And this is the idea behind this program. The program is designed around not guessing the law and not guessing the maths. Right, I think with that, I'm comfortable to give over to Rex just to give us the perspective of that 4th silo.
Thanks very much, Louis.
Thank you, Louis. And I think what comes out so strongly in those wise words of yours is that there's 2 sides to this. There's the psychological side of succession, and then there's the practical side of succession. So I'm going to focus a bit more on some of the practicalities. And there was a few themes I was writing down there when Lou was talking, and one of them is preservation, and then of course the other one is preserving to the point where you need to transfer. So I'm going to look at some of those themes as well. I think the one thing also to consider is that chart that Louis put up with that graph showing the wealth that's needed over your lifetime sort of diminishes, but your wealth increases. The one part of that journey that I know when people look at these presentations and follow it, we're always focusing on that end point of that arrow, the point of death. But what Louis did allude to was the importance for preservation, and therefore protection of wealth throughout this journey is equally important. It's the catastrophe events that apply in our lives that make us poor. And as your client said, Louis, I'd rather get rich once than have to get rich twice. I think is a very good, it just helps me to illustrate that point. In that if you have accumulated wealth and something happens at a point later on in life where you lose that wealth, the time and opportunity you have to recreate wealth is significantly diminished. Yes, you might have the ability, but do you actually have the time or the opportunities to recreate it? So I'm also going to talk a little bit about protecting the wealth along this path, along this journey to when it gets handed over to that second generation. Sean, can you flick the slide across for me?
Sure, there you go.
Perfect. So I think what I want to have a quick look at is some of the pros and cons of these different silos. Sean, for simplicity, you might as well just bring them all up, and then I can just talk to each of those silos, and I can introduce what those words mean. Okay, so I think in broad terms, as Lou was saying, you've got these 4 different silos that your wealth sits into. And if we focus on silo 2, I think the point Louis was making there was that these assets are probably the most inefficient assets that you have. What you've got is you've got access to them, and you can choose almost unlimited choice what you do with them. But they're the assets that are most at risk, and therefore they don't have any structure to actually protect them. And when I say protect them, I'm saying protection against any claim against your estate, against things such as divorce, creditor claims. If you're an entrepreneur and you've signed a personal guarantee and something goes wrong, if you have a business, you're a director and something happens and you end up carrying personal liability, these the kind of things that can actually have a huge impact on your wealth. And of course, not to forget Sean's words at the start of this presentation, where he said that just the impact of taxation can at least diminish your wealth by 30%. So these are all things that can come to play that erode the wealth that you are creating, and assets that typically sit in silo 2 are most at risk of these kind of challenges that come along. We talked a bit about, or Louis talked a bit about silo 1. I think if you can just pop back a second there, Sean. And silo 1, trusts have been incredibly useful for addressing these issues, the risks that personal wealth face, because of the protection that they provide. And at some point in time, they also provided a level of tax efficiency. However, governments all around the world have chosen to legislate against trusts, and they haven't legislated against them in terms of their legal characteristics. What they've legislated against them is in terms of tax. So we've seen trusts being used over the years to gain tax advantages. Tax authorities obviously don't like this kind of concept. They feel it undermines the fiscus, and therefore we've seen tax legislation harden over the years against trusts. The idea being that there is no tax advantage from the trust, and therefore they'll only ever be set up if there's a genuine financial planning requirement for that structure. So tax no longer becomes a consideration, and it's really pure financial reasons or commercial reasons that the trust is going to be put in place. And I think let me go through some of these points. So because of these changes, for those of you that have assets in a silo one, in a trust, be it a domestic trust or an international trust, some of the challenges that have come along have been the introduction of deeming provisions, most notably 7.8 and 7C in terms of the Income Tax Act, and this really looks at ensuring that where you make a donation or a settlement to a trust, that the income and capital gains within that trust are attributable to you on an arising basis. So it's effectively taxed in the same way as a box 2 would be taxed. And of course, to overcome this, what would happen is you would set up a trust with a small amount of money, and then the remainder of the funds would be introduced by way of loan. That loan wasn't part of a settlement, and therefore the proceeds of that loan would be invested, and your trust could grow, the investment assets in your trust could grow, and none of the gains or income would be assessable for income tax because they weren't from the original donation or gratuity or settlement, whatever you wish to call it. And of course, we've seen tax legislation move against that, and these loans now have to be on a commercial interest rate with proper commercial terms. In other words, again, it's making the trust uneconomic unless there's a real purpose for it. Now it's going to impact on cash flow, and there's a real cost now to having these loans. So a lot of people are looking at what can you do if you have a trust that was set up. And I think that, and I'll come on to this on the next slide, is a lot of the characteristics of trusts are incredibly useful for the protection and passing on of wealth. How do you retain all of those advantages, but address some of the issues that have arisen as a result of changing tax legislation? And I'll also touch on amnesty. Louis, if I forget to talk about amnesty, do prompt me on the next slide, thanks. I'm not going to talk too much about Silo 3 assets in terms of companies. As Louis said, there's ultimately a person that owns it at the end of the day, so I see them very closely related to Silo 2. And then, of course, in South Africa, Silo 4 assets, I think, are viewed almost in the wrong light. We see retirement plans. We think about tax relief contributions into a vehicle that's going to provide some form of taxed income for us later on in life. What is often overlooked are the asset protection characteristics that a retirement asset actually provides to you. And in actual fact, a pension scheme is very akin to those assets in Silo 1, but it doesn't have the progressive approach to taxation or hardening taxation that Silo 1 has. So what we see in terms of Silo 4 is the exact opposite. We see pensions being given significant tax incentives and exemptions in order to people to put private wealth into Silo 4. So Silo 4 are structures that are seen as, I would say, as prudent vehicles to use from a tax perspective, where Silo 1 assets are typically seen as assets that are that could potentially be where the fiscus could potentially be at risk. So I think the point with Silo 4, as I said, it carries a lot of the characteristics of a trust, but not necessarily the downsides from a tax perspective. So if we flip over the next slide, please, Sean. Perfect. So let's have some considerations. And what I'm going to talk today really is very much to do with the internationalization of wealth. So making the conversation even more narrow and focusing at those funds that you're going to put into the international space. In other words, invest them in assets outside of South Africa. There were just a few points I wanted to pick up also on what Louis mentioned. And I'll come on to those, but I think as a nice to put it into context, you know, the purchasing power of 100 rand back in 1980 in today's world would be around about 2 rand 80. So in other words, to actually have retained that level of purchasing power, you would have had to have 2,800 rand back in 1980, and that's what shows you is the depreciation of obviously the rand versus hard currencies over the longer term. And it's not just the rand, it's the Turkish lira, it's even look at the Australian dollar. You see emerging market currencies devalue against the major currencies over time because of the effects of inflation. So the reality is, as part of the asset protection argument or the wealth preservation argument, particularly in today's world, it's considering your assets as a global citizen. Yes, you need to have rands if you're going to live in South Africa, and that's important because your base expenses are in South Africa. But the family unit is changing or has changed. We're seeing in many instances people working abroad, accumulating wealth abroad because the opportunities are there. We see the kids emigrating or living abroad. They're following lifestyles outside of the country, and therefore, again, ensuring that your wealth retains its value on a global stage becomes important. It was only the other day I was dealing with a family where the father actually had quite a lot of money, but his kids are all overseas. And the conversation around the coffee table after his passing was very much around, you know, if we were back in South Africa, we'd be rich people, but not anymore because dad's money was all in rands. And they sort of took it on the chin, but it was a bit of a joke, and you know, I had to laugh at it, but saying if only had put some of his funds in hard currency, it would have retained its buying power. So I think when one looks at succession planning and this preservation of wealth, it's no use just looking at it from a domestic perspective. You've got to consider it from a global perspective, because we live in this globalized world. And of course, that's something that Sion and his team look at. But the point I'm going to make here is to move on to, I'm talking a bit about this because I'm going to specifically look now at, on the screen, we've got a Silo 4 asset, but this is an international asset. So we're actually now saying, well, what I'm going to be looking at now is to address a lot of the issues that's been mentioned. Let's look at the potential use of an international retirement plan to sit alongside your domestic retirement plan to broaden out Silo 4. So this is in no way a replacement for a local South African scheme. It's a complementary vehicle for your overall wealth management solution, and the particular focus on protection and succession. So if we look at some of the basic advantages that you would get from your international scheme, that first bit about asset protection. So your international pension schemes in general enjoy significant legal protection. So once those assets are in there, there's no claim from third parties that can be permitted. So you, no matter what happens in life, if there is an external party that challenges your assets or tries to claim your assets, they are protected. And remember, that'll extend to.
We seem to have lost Rex for a minute there.
Nationalization of wealth. We've seen a lot of clients very successfully protect their assets where they live in countries where we've seen nationalization of personal wealth. And of course, there's always a concern in South Africa, given that the overall stance is on wealth redistribution, and we've got, you know, there's a lot of there's papers and that are being put forward, noticeably the Davis Tax Committee paper on wealth tax and the need to introduce a wealth tax into the country, and because of the disparity between wealth. And as Louis points out, there's 2% of people that have the wealth and the rest don't, and the view is that that wealth needs to be shared to create a more equal society. Right or wrong, that's the view. So protecting those assets from, I would say, political risk, together with creditor and commercial risk, is just as important. So again, your assets that sit in your international retirement plan, they sit outside. In our instance, we use Guernsey. It's a very good jurisdiction. So those assets sit in a different country, and those assets are subject to the laws of those countries. Of course, you are a member of that scheme, and of course, if you remain in South Africa, you are subject to the laws of South Africa, and anything you receive from that scheme or your heirs are subject to the prevailing laws at that time, which including tax. So, but you've got that asset protection function in place. Hard currency, you can invest in pretty much any currency you want. Again, that investment discussion is something that Sion should be having. But you've got freedom to invest in, in international stock markets. companies like Google and Coca-Cola and Disney, and those opportunities you just don't have on the JSE. So, you've got that. So you've got asset protection, your hard currency, and your international investments. And importantly, as with other pension schemes, you get your tax-free roll-up. So the roll-up of any gains and income that you're making from those international investments are not subject to tax at the point in time in which they arise. Of course, Silo 2 assets, they would be. Silo 1 assets, they wouldn't. Okay, so again, it's getting the same benefit that you'd get from your Silo 1 in terms of that roll-up environment. I think it's worthwhile just touching on amnesty now before I forget it. Again, if you've got offshore trusts that are subject to amnesty, one of the conditions to conclude amnesty is for that trust to dispose of those assets. So again, those old trusts that that have gone through an amnesty process and aren't particularly efficient, instead of waiting for the settler to pass away, you could always look at effectively converting that trust into a pension scheme. It's not correctly the right technical term. You would actually see a distribution from that trust into the retirement plan, which would be a beneficiary, but the effect, that's the effect. And then you can wind up those old amortized vehicles, and then you get your efficient solution in your retirement plan. So you do away with those conditions of amnesty by meeting the conditions of the legislation. So for amnesty trusts, again, Sean is the guy to speak to about that. When it comes to succession, there are no requirements on international schemes that you'd have on a domestic scheme. So domestic schemes, the trustees have to unpack those assets in line with very specific rules. With your international scheme, that's not the case. So you've got your assets, and again, it's not subject to the laws of South Africa in terms of probate, which means you've got real freedom to start to consider on how to distribute those assets. How does that baton get passed at that point in time? I suppose the other very important point, which is around when you hold foreign assets, and Louis did talk a bit about this, is if you hold foreign assets in your own name, you need a foreign will in that country to deal with those assets. And that's because those assets are situs there, and therefore they're subject to the laws of that country. And I see a number of clients who have assets in multiple territories, which effectively means to wind up their estate properly takes a significant amount of time. And they've got South African wills that will say this will covers my worldwide assets, but because it's a valid will in South Africa, doesn't give it any legal standing in another territory. Is it a valid will in another country, and how do you make it valid? And all of those things add to the complexities of estates, which I know Louis could speak to much better than me. But we see the challenges that arise from holding Silo 2 assets offshore as opposed to holding Silo 2 assets in Silo 4 offshore. So yes, so in terms of dealing with matters of succession and probate, the retirement plan mitigates all matters of foreign probate. It also mitigates all matters of foreign wealth tax and foreign estate duties or inheritance taxes. So again, a very, very efficient vehicle. And the advantage of that is that you're living here in South Africa, assets that go into Silo 4, you now only have to consider from a South African tax perspective. All those international complexities, which can be very costly, both in terms of monetary cost and time to sort out, are automatically mitigated through the international scheme. So I think that covers some of the advantages. Sean, just see if there's anything else that comes up on this slide. Okay, see, keep going. Let's see what else comes up. I think I covered these points. So it's sort of, I almost summarize here. Moving assets potentially from Silo 1 into Silo 4 to modernize your affairs, and going into a more, I don't want to use the word, but I'm going to a more acceptable structure. It's not fair to use that word, but I hope you understand what my meaning. And at the same time, you mitigate your political risk, you simplify matters because you can unwind and deal with all of those issues that have arisen from changing tax legislation. The other point here, international portability, which I didn't talk about. I talked about the family living abroad, but I didn't necessarily talk about the patriarch or matriarch, where they might live. So, which might be you that are on the call. So again, the nice thing with having international assets in a neutral territory in international retirement scheme is, if you choose to go and live in another country, you can access those assets from there. You don't have the complexity of trying to access or accessing retirement for assets that are in a South African structure that you would have. Or indeed, if emigration is on the cards because the kids are now all living abroad and you want to go and see be close with the grandkids, again, those issues that arise given changing legislations around emigration don't apply to your international schemes. They obviously only apply to your domestic schemes. So yes, generally just speaking, there, looking at that as a significantly more, or let's say a vehicle that adds significant scope to your box 4, which I said is often overlooked. And reason why part of the conference today was to really put an emphasis on this and open people's eyes to the opportunities of using international structures to complement their domestic arrangements, given the need to internationalize wealth, but in a safe and secure environment. I think that sort of sums it up from my side. I don't know, Louis, if there's anything that you want to pick up on there, any point that you think needs additional emphasis?
Yeah, I think the big message here is none of the 4 is, it's not saying that the one is good and the other one is bad. It's understanding the vehicle and understanding where the wealth is in and understanding the rules of that, and then just broadening the horizon. And I agree with you, from a South African point of view, we do see Silo 4 differently from what it is seen internationally, and it's a bit of a blind spot. The big thing here is when you enter into these conversations, what are the conversations about? And it should really be across all 4 silos for the 2%, and we're talking about the 2% here. And it's understanding the value of each of these vehicles, but then very importantly, making sure that your succession plan spans the 4. That your succession plan isn't geared towards one of the 4, and depending on who you talk to, it should be all 4. But Silo 4 in a great to a great extent in South Africa is massively overlooked because we've got a very narrow view on what a pension plan is. Just very importantly is when you use the pension, and it's a discussion, Rex, that you and I have often had, that if you use Silo 4, it should act like a pension, it should be like a pension, it should be managed like a pension, which means that if you have got a pension fund, you don't control necessarily the investment decisions, etc., etc. And it's very important that it behaves in the way in which it is designed to. The same for a trust. If you manage a trust as if it's your own assets, don't be surprised when the trust vehicle fails you, because you didn't respect the rules of that silo. And you can say the same for a company, etc. And it is understanding that. Very important, your advisor should understand that, because we don't expect clients to have intricate knowledge of what we've discussed here. What we do expect is from an advisory level that this is at least a discussion that happens on this level with you.
And just to pick up on that, I think it's a very good point, Louis. I think it was March or May last year. I can't remember the exact date, but there was a press release that went out in News 24 and on some of the other channels, where the retired judge Dennis Davis, who obviously headed up the Davis Tax Committee, was asked about the use of international retirement plans. And to paraphrase him, he said, be my guest, you can use one, just make sure you're using it for the right reasons. And I think this plays back to what you're saying. I've seen so many South Africans with domestic South African trusts, where if those trusts were ever tested in a court of law, they would not exist because the rules aren't being adhered to. And it's the same for any of these. In fact, Dennis Davis, he said, the same applies whether you're using a trust, a company, or a pension. Stick to the rules. And I think so. So the rules, I think, is where the complexity comes. And if you stick to the rules, all of the benefits of these vehicles will manifest. But you have to stick to the rules. And I think the other point as to why South Africans haven't used Silo 4 from a global perspective or international perspective to date has been exchange control. You know, it's only until recently that you've been able to put funds offshore in excess of any meaningful amount. I mean, now you can do your 10 million investment allowance plus $1 million on your discretionary allowance. And in the last budget, you know, it was confirmed that you can actually use these funds now to set up an offshore trust. You know, that was in the budget, and where previously you couldn't use your investment allowance to set up offshore trusts. So the nice thing is we're seeing the Reserve Bank and the policies and direction of the Reserve Bank is really to reduce exchange control so that people can internationalize wealth, because it's in the country's interest that the overall personal wealth of the population retains its value, and that exchange control has been incredibly detrimental to the country's balance of payments, but also to foreign direct investment. So I think we're going to see a continued modernization of our exchange control, and my guess is that we will get to a point where we're a bit like Netherlands or Italy, one of those countries that have exchange control. Not that anyone knows it, but that exchange control has basically become the actual tracking and monitoring of funds. And it's even in a lot of people say, oh, you're putting money offshore, that's not in SARS's interest. Of course it's in SARS's interest, because if your funds grow better offshore than they do domestically, it improves the position of the fiscus, because obviously you have a better contribution or a higher contribution to the overall tax take in the country. But in order to facilitate that, they need to be able to have visibility on assets. And I think we're at a point now with common reporting standards, and the Reserve Bank's record keeping is excellent when it comes to offshoring investment. So I think this is all driving I would say, the modernization of exchange control. But people then need to understand what vehicles are available now that they can properly internationalize wealth.
Thanks very much, Rex and Louis. That was really informative. Questions just popped up here, which actually often pops up really in a lot of meetings I have. And that's, I've got assets offshore, I've got investments, I've got equities offshore in various either direct stocks or unit trusts. And no one's really told me about this offshore pension. Now, to move it, obviously, is going to trigger costs and taxes. Is there a way, what's the most efficient way of doing it, and why I'll pay the taxes? So, I mean, I'm happy to answer that myself. And really, the reality is, yes, you're moving it from your own name into a more tax efficient and protected environment. So you are changing the entities. And yes, you will have to pay the tax. But the reality is, as was alluded to earlier, SARS and the fiscus are looking for more taxes. So at one point in time, taxes are going to be paid, and the reality is that taxes are generally going up, not down. So you need to draw a line in the sand and say, okay, well, you either bite the bullet now, or someone is going to bite the bullet later at probably a more expensive rate.
So, I think that's right. And CGT in particular is a tax that will be paid. You know, a lot of people will say that if you look at our estate duty rate, you know, it's actually relatively reasonable, but they forget that we pay CGT. Death is a taxable event for CGT. So at some point in time, CGT will be paid on any asset, you know, unless it's an excluded asset. So if you take the hit now, you've got certainty of what rate you're going to be paying. And, you know, paying tax at 18%, I'd happily pay tax at 18% all day long. So, you know, and I think that comes back down to the comment of Dennis Davis. Just do things right, and everything will, and you'll be able to take the benefit of the planning that you put in place. So taking a tax hit now, it's going to happen at some point in time. At least, you know, it's only 18% at max.
Look, there's a silver lining at the end of every. So obviously we had a bad downturn in the markets now. So when your assets are down now, this is probably an ideal time to actually shift structures, to move from your personal name into a trust or into a pension, because that tax hit is going to be minimized, and you can just replicate what you had before afterwards, and then the upside theoretically will be protected. So this is actually an opportunity, and it doesn't come along so often. One time was during the beginning of COVID, and now with the silver lining, yes, the markets have tanked, but they will come back. I'm confident on that. And whether they come back, how do you own those assets?
And the interesting bit there, Sean, is for whoever asked the question is, You don't have to sell your assets. You can transfer them in. So you don't have to be out the market. You don't have to expose yourself to market risk. It's just a change of ownership from yourself to the pension scheme is the taxable event. So depending on what those assets are, but if they're typical blue chip stocks and shares, listed equities, etc., you can just transfer those assets across so you don't suffer market risk. It just does trigger the tax liability. So you're not going to have to sell out, incur that cost to buy back.
The capital gains tax is a stealth tax. It's a curveball tax, because what we see in deceased estates, for instance, everybody plans around liquidity, and then this stealth tax hits you because you might have owned your assets for 10 or 20 years and you haven't sold that. So transferring it now into a structure of any kind, it's not as if you're paying additional tax. It is just you're realizing that stealth tax. We find it in the deceased estates, because that's part of the liquidity problem we've got there, where you've held an asset for 20 years, it sits offshore, and that multiple growth you've got on that, etc., causes huge havoc in the States. So it's not an additional tax. It's you're just getting a little bit of a taste of that beforehand. We see the consequence of that in the States, and at least you manage the liquidity. So at that stage, you're in control of that liquidity, and you at least stop that going forward. That stealth tax keeps on hitting us in the deceased estates, but it causes havoc for us. I can tell you now.
Thanks very much. So just really in summary, I think the two takeaway points is, one is, first of all, is obviously manage your wealth overseas in maybe a different way, or locally or overseas in a different way rather than in your personal name. And the second takeaway is just understand what position you're on now. You don't want to do things just in your head. Get your L&D, your living liquidation distribution account drawn up, so you can actually discuss it with your family and know exactly what's going to happen with your funds and assets that you built up over your lifetime. So for me, those are the two real key elements that people need to focus on, and I find it's not really focused on a lot. So thanks very much. I'm not going to take everyone's time up. I think thanks very much, Louis and Rex. I mean, we can talk about this for hours, but there is limited time. And if anyone wants to take this further, happy to give me a call, an email, and we can take this further in person, via Zoom, or however you like. So thanks very much, and we'll hopefully see you all guys soon.
Pleasure.
Thank you.
Goodbye, everyone.
Yeah, that's fine.